in the house?
We are in the house, and I swear I feel like that'd be like the longest minute for the countdown. I'd be like, that's a long minute, you know?
That's funny. Well, what questions can I answer for you today, Miss Realtor?
Let's talk about. Okay, first off, I looked at the mortgage rate. Right now, they're saying FHA is like 6.25. Is that pretty accurate, or where's the rates at right now?
It's pretty accurate. I say a couple of things. One is you can have any rate you want. You just got to be willing to pay for it.
Okay.
And rates change daily. Like rates change by the minute. Rates are like the stock market, right? So you wake up, rates are one thing, and later on this afternoon, if you haven't locked that in, you could be looking at a different rate. But rates have flatlined and even shown a little downward trend over the past few weeks.
Okay.
Mortgage applications are picking back up, which is always a good sign that people are trying to, get qualified so they can go out and buy. And because rates had crept up so much, a lot of people had got out of the market. As far as I'm gonna wait. Rates are affordable. Rates, that's my common thing is if you can afford it, it's a good rate. You can make the payment, it's a good rate. But rates are lower today than they have been in the past few weeks. And if you go back 2 months, rates are great right now compared to where they were at 2 months ago.
Okay. I feel like my picture is really dark.
Yeah, it's like fluctuating with the light behind you.
Yeah, I got something going on here. But so I, every morning I get up and I ask Siri. I don't want to ask, I ask Alexa, what's the rates? Then of course, there's different apps and everything where we can kind of gauge where the rates are at. So we can kind of educate our clients on it, because it's when people, one thing I'm noticing is when people are not aware that the rates are not as high as they ever been. I was talking to someone and they literally told me, they was like, no, this is the highest. And I'm like, no.
It's the highest compared to what?
The highest at all. Like if you talk to your parents and stuff, like I'm sure they'll be like, nah, 6 is good. You're fine. You're fine. Yeah. And like you said, you can, there's different ways around that too. I love for you to talk about, and I think we hit on this last week, but for you to kind of talk about the buy down, because I know that that's one thing that a lot of people are either they don't know about or they want to know about it. They want to know more about it.
So there's actually 2 different frameworks for buy downs, right? One is your traditional, what we call discount points, buying down the rate. So that is the consumer who's filling out the loan application. They get quoted a base rate. Let's call it 6%. You're going to be at 6%. And they're like, well, is there any way I can get that lower, right? Yeah, you can pay the bank some money up front right now. And in lieu of collecting that interest over a longer period of time, they'll give you a discounted rate up front. And so what that literally means, and actually, am I set up to screen share? Let me see. It says host has disabled participant. Maybe Chazon can hook me up and let me know when I can share. So that's our traditional method, is buying down the rate ourselves, and we call that discount points. Now, I actually have a buy down calculator. Let me see if I can. Let's see.
Okay, he said that you can share now.
Oh, okay. Well, let me take people behind the curtain, right?
Okay.
So this is an idea of what temporary buy downs, or excuse me, not temporary buy downs, but what buying down a rate would look like. So we're just going to use you'll give me a scenario to work with here. Give me 1 second.
Okay.
Or give me 2 seconds.
Look, I'm not laughing. I'm not saying anything because my internet is like very patchy. I came downstairs today, so I said, okay, it might work better.
All right, Miss Jones, what is
All
our
right.
borrower's FICO score?
All right, let's say that their credit score, their FICO score is 600.
All right, 600
Let's do that.
FICO.
600.
And we'll just give them a 50% debt to income ratio. We'll say that they have, 1 month's reserve, go to 3. Not going to make a huge difference on that part until we actually get into a loan. Now with a 600 FICO, they're going to need to go FHA.
Yeah.
So we're going to go FHA. We're going to say that they're purchasing. We're going to say that they're purchasing at $500,000. And they want to borrow that 96.5% of their loan amount. Okay.
Right.
And let's put them in a county out there in Georgia. So what do we go with?
Let's go with,
Go ahead.
yeah, 30016. Let's try that.
Right. Let's see what we got. We're in Newton County.
Yes.
Buying a primary residence. It's a single family home. It's 1 unit. It's detached. All that stuff matters. And so that goes back to your original question. What are rates like? Well, answer all these questions before I can quote you a real rate. And so anytime you ask Alexa, right, or Siri or Google, and you ask bankrate.com for a rate, that rate is based off of some fine print. And really, you should look at that fine print to see what that rate is based off of. That's the first step. It's like, what are you comparing that to? Is it 50% loan to value? Is it 96% finance? Is it a 30-year conventional? Is it a 30-year FHA? All of that stuff matters. Is it full doc? So what we assumed here is that we're doing a full doc loan with a borrower with a 600 FICO, and we'll just get some rates to pop up here. Okay. So here is the base rate right there. You see that says 5.625%?
Yes.
And if you look right above it, it says 5.5%. Over here, this is the price. And this is what you won't get from a bank that you'll get from a broker. Yep. So the difference is pretty simple. Okay, let me jump in here. This thing open up. Open up. Oh, that was your 3 rates. Okay. 5.5% is the rate, but this needs to be 100%. When that's at 100, that is a base rate to a consumer, and it is what it is. Okay. Now, when you see a positive number, you're over 100. This difference here where it says 0.161, that's credit. That is credit back to the borrower. That's when you see lender credit on your loan estimate. Okay, so when you heard that rates were at 6.25, 6.25 would have a really good rebate to it, because as you can see, 5.875 is giving about 0.5% back. So what that means for consumers, let me just do some quick math. $500,000, 96.5% purchase price. We're borrowing $482.5, and if we can get 0.5%, that's $2,400 right here back to the consumer. And so when you want to talk about discounting a rate, you come in the door and I say, oh, you're at 5.875. And you say, well, can I get any lower than that? Well, sure. If we want to start paying discount points, the further we go below 100, that is money that the borrower needs to bring in to help close escrow.
Okay. And
that is going to discount your rate right off the top. Now, the reason why you see all these different rates here, these are actually just different lenders.
Okay.
If we went to SunWest right now and said, hey, SunWest, hook me up with a 30-year mortgage, here's the range that they'll give us. Let's see. See that? At 6% on a 30-day lock, meaning, that's your typical mortgage. We want to lock our rate, be secure for 30 days. If I put you at 6%, I'm actually giving the borrower 0.9% back. That's credit. That's in a $480,000 loan amount. That's almost $4,000 towards closing costs.
Yeah.
That's at 6%. But if we want to worry about the least amount of closing costs as possible, then we can keep going on this rate. You see here, we start talking about affordability. Can you afford 6 1/4?
Mm-hmm.
Can you afford 6 1/8? At 6 1/8, I can give you back 1.3% towards your closing costs. That's a good amount of money.
Yeah. And it's a perfect situation too, because this was going to be my next question, because I'm well, I'm working with a client right now and they don't have a lot saved up as far as their, for their down payment and closing costs and stuff like that. So I think whenever I hear that a seller, or not seller, but a buyer can get some help from the lender, it's very favorable for people to move now.
It is. And I try to explain rates as the stock market, because people need to understand, again, I said any rates available to you right now. There are legal guidelines. You can only spend so much on securing your loan, and then you got to stay within those parameters. But for the most part, like looking at this rate stack right here, 5.5 is the aggressive rate. Mm-hmm. It's just going to cost the borrower a little bit of money because that's not at 100. So the borrower has to be willing to make that 100. Now, that doesn't have to be the borrower. That could be the seller's credit towards closing costs. That can be a realtor saying, oh, donate $500 at close. Boom. Right. Now we're at the 5.5 instead of the 6. But if this is affordable, let's say 6.5, we do the calculation on the payment, that's affordable. Now we've crossed the hurdle or jumped the hurdle of, I don't have enough money for my closing costs. Okay. And let me do that math one more time. So at 96.5%, we're borrowing $482,000. Mm-hmm. If I can give the borrower 1.8%, which is, if I can give the borrower $8,685 towards their closing costs, because they can afford the rate or the payment tied to the 6.5% rate, then that's the best loan. Yeah. And they're gonna say, well, my friend just got a 5.5. But your friend had his own closing costs. Mm-hmm. You're asking for closing costs. And I ask my borrowers, what's most important to you? Cheapest way in the house or cheapest payment? Right. Can't have both. You gotta pick one. You want the least amount of money out of your pocket, this is where we're gonna look. If you want the lowest payment every single month, we're gonna look here. Mm-hmm. And that's how rates are affected, based on what it is you need to accomplish going in. Cheapest money out of your pocket or cheapest monthly payment going forward. That is a permanent buy down. So we were at 6% and the borrower came in with that little bit of money to get this back up to 100. His rate will stay at 5.5% forever. Mm-hmm. Okay. So that's your permanent buy down. A temporary buy down is where the borrower brings in a little bit of money for his normal closing costs, and he gets a normal 30-year fixed rate. So let's say it's at 6%. And let me see if I have this.
And you know what I'm going to ask you next too? What's a little bit of money? Is that 10,000? Is that 5,000?
Well,
is it 20,000? What does that look like?
Closing costs are different from down payment. So let's draw that line first. Mm-hmm. So down payment is the money that's going to go towards the principal price of the house. If you come in with 3%, you're only borrowing 97%. That was your down payment funds, that 3%. Closing costs, for all intent and purposes, is all the line item issues with closing. You need an appraisal, you need a credit check, you got to have title insurance, you have to have a settlement agent, whether that's an escrow company or a real estate attorney. They all have fees. No one's doing this business for free. Right. Things you cannot get away from. Things you cannot get away from. Some lenders will say, we'll pay your closing costs. Well, guess how they're paying your closing costs? Right. Right here. That's how they're paying your closing costs. It's based on the rate. Mm-hmm. So if I charge you $8,000 in closing, but give you a rate that has 8% credit, you didn't have any closing costs. Right. Okay. So the answer to your what's a little bit of money, normally your closing costs are going to range anywhere between 1% to 2%, even as high as 3% of your purchase price. Okay. And the reason why it's going to range there is, again, what kind of credit are you going to have, or what kind of discount money are you going to have to pay towards the rate? Is the lender charging you for the rate or not? And you really want to go behind the curtain? Let's go behind the curtain.
I like going behind the curtain because it gets juicy then.
Hey, it is what it is, right? Loan officers don't work for free either, right? When's the last time a realtor sold your house and said, I'm not even going to charge you to sell your house? I just
right.
Free. There's some cost involved. So let's just go back to like a well-qualified borrower, a 620 FICO score, 50% debt to income ratio. They can get either a conventional loan or an FHA loan, and it's going to be a purchase. All of this other stuff is going to be the same. And they're going to borrow 96.5%. Actually, well, we'll just go the FHA route because conventional, then we have to bring in the 97%. We want to confuse the computer here. FHA 96.5. Now, you want this loan that says 0 points, right? I don't want to pay the bank. I don't want to pay the loan officer any money. Okay. You see right here, it says target price is 102.75.
Okay.
Remember, it's supposed to be at 100. At 100, it's even. Anything over 100 is money back to the borrower, or it's the lender's compensation, right? And so we don't work for free, but if we give you a loan that says 0 points, it's because we'll take the compensation directly from the bank. Okay. Now look at where your rates are at. You want a 0 point loan? You can have one, but look at the numbers.
Those rates
go
all
up. Of this will now up to your compensation point, right? Everybody has a different contract: 2%, 2.25%, 2.5%, 2.75. Everybody has a different contract, but whatever your contract is, let's say mine's at 2.75. Here, I still need a little bit of money from the bank. That's not enough, so I can't give you the 6.625. Most likely, that rate right there is going to be closer to 6.75. Here we go, 6.875. Now we're over my compensation. Actually, still a little short, 7%. 7%, I can get my 2.75 and give the buyer some credit. Okay, it's all numbers. Some of it, people are like, "What did he just say?" This has to be 100. If it's not 100, if it's below 100, somebody has to pay for that. That's the borrower. Yeah. If it's over 100, the excess goes to the borrower, or it is the lender's compensation. You know the difference when, if you look at your loan estimate and it says loan origination, 0 points. This is where your rate's going to be, because it's not 0 points. This money is being generated on the backside of the deal, and that's where the lender, the broker, the loan officer, that's where their compensation will come from. Conversely, I can tell my borrower, you pay me. I don't mean like Zelle me no money. I mean, I'm going to charge you loan origination on your loan estimate. You're going to see loan origination. But then I can credit you back all of this money to offset that loan origination. So technically, you didn't really come up with any money out of your pocket. Now, if you actually have your own money for your own closing costs and your own down payment, and you don't need anything, then we'll just find the number that has zeros next to it, just 100 across the board. And that's going to be the best rate.
Right.
That's how that works. Now, with respect to, let me see, I think I have a calculator in here right now. Those are permanent buy downs. That's how we're going to keep our rate down forever, right? Now, a temporary buy down is something a little bit different. It's pretty easy to figure out how it works. And so I've got this calculator in here, okay? Oh, look, Cofield family and Ms. Leah Jones. How nice is that? All right, so here's their loan amount. We're going to leave it all like it is. Here's their loan amount. Here's their purchase price. That's the initial rate. That's the rate that they're being quoted. Being quoted a rate of 5.875% for the next 30 years. Okay, that's 12 payments a year. Their monthly payment is $1,508. The total payments is going to be 360 payments. What a buy down, there's different versions. And here we're illustrating a 1-0 buy down, a 1-1 buy down, a 2-1 buy down, a 3-2-1. What this means is in the first year, you're going to have a 1% reduction. And then in year 2, there is no reduction. You're going to go right back to your normal payment. So this right here is us asking the seller, the potential seller. We're going to say, hey, seller, we want you to help us out with a little bit of money for our buy down. Okay.
Yeah.
And so in year 1, instead of 5.875%, we get a 1% reduction on our rate. And it's instead of being at $1,508 for the full payment, we're at $1,349.
Mm-hmm.
Okay. It says the annual buy down cost. It costs $1,907 to make that happen because it's annual, done over the 14 months.
Right.
And you say, well, what does that equate to? Or how does that have to happen? The seller would need to give us $2,231 in credit. And then for, what I haven't explained where all the money is, just to say escrow holds that money. And then you make a payment of $1,349. And then escrow takes the difference out of there and puts it to where the bank gets the full $1,500.
Okay.
After 1 year, you're back at your normal $1,500 payment. Okay. A 1-1 buy down is just basically in year 1, you're going to get a 1% reduction. In year 2, you're going to still get a 1% reduction. And this is what that looks like. Instead of being at 5.875, in year 1, you're going to be at 4.875. In year 2, you're going to be at 4.875. Your savings is $1,900 a year for both years. Where does that money come from? We simply ask the seller, hey, at closing, can you please give me $3,814? That is going to offset that payment for 2 years. The most aggressive buy down is actually a 3-2-1. Okay.
And I think
So
that's
now,
the one that you were telling me about. Okay.
Yes, ma'am. Now, I want my screen go down. Let me see if I shrink the size of my screen. There we go. All right. So now for year 1, we're going to get a 3% reduction. And for me, this is more than just a discount to the buyer. This is a marketing tool for the real estate agent.
Yes.
Instead of putting a price reduction of $10,000 on the house, why not give $11,000 in credit? Sell that house at full price.
Yep.
And in the first year, I don't know how you would market it, but I'd say buy this house and enjoy a 2.85% rate for the first year. And they're like, no, okay, now they're asking questions. What do you mean? I thought rate was at 5.875%. Oh, it is. But we're going to discount your rate by 3% for the first year. Now that costs money, $5,400. We're going to discount your rate for the second year by 2%. That's your rate for year 2. That costs money. We're going to discount year 3. That costs this much money. The total is, again, $1,102. How do we get there? Hey, Mr. Seller, can you give me $11,020 in credit at closing? Because if you can, now my buyer is not stuck on this 5.875% $1,500 payment. They're looking at a payment of $1,057 a month for year 1, $1,200 for year 2, and $1,350 for year 3. And why is this a temporary buy down? Because in year 4, you're back to just your normal payment. And what I'm telling consumers that are considering this is that everyone wants to wait for rates to go down. No, let's get in the house now.
Yes.
Let's take advantage of this temporary buy down. And if we all believe rates are going to go down later, cool. In year 4, we will see where rates are at. And if rates are lower than 5.875% in year 4, we'll go ahead and refinance. They say, well, what if rates come down before then? Then you can refinance ahead of then, and any money left over in this column gets applied towards your principal buy down. That is not money lost. that money will go as credit towards your refinance right there off the top. That will pay off some of your principal balance.
That will make a world of difference in getting, I mean, now, of course, you would still have to qualify at whatever the rate is.
You do
But-
qualify at the full rate, correct?
Right.
You got to qualify there. This just gives you some cash flow savings.
That gives you some cash flow savings to get started, especially whenever you first purchase a house and you want to do some other things and everything. Now, Kamara asked something about the APR. I'm trying to find the question. Should we compare the APR when looking at rates?
Absolutely. So the APR is really the cost of the money, right?
Mhm.
Interest rate is how much interest the bank is making. APR has calculated all of your closing costs into that loan. So did you pay loan origination? That gets added to what you paid over the life of the loan. Did you buy or pay any discount points? That gets added to what you paid for the cost of the entire loan. What is your appraisal cost? That gets added to the cost of what you paid for the entire loan. And so APR factors in all of those numbers, whereas interest rate is simply the amount of interest you're paying on the loan by itself. It's not calculating the rest of the costs associated with your closing costs.
Okay. Look, I know we kind of dived deep into the, we were supposed to be talking about the beginning process. But I wanted you to go into that only because I had just got finished talking to someone about that.
Yes,
But
ma'am.
I know today, look, and we got a couple of minutes left, about 30 minutes left. So day one. If someone says, hey, I want to purchase a home, or they just got that notice and they said that their rent is about to go to $2,500 now. And it's like, okay, that's a mortgage, right? We know that's a mortgage that you're paying. You're just not paying your mortgage at the time, but you're paying somebody's mortgage,
You're paying
right?
somebody's mortgage.
You're paying somebody's mortgage. So day one, and they have a job. They've been on their job, what? How long do they need to be on their job? What, 2 years?
Well, that's a great question. They need to be employed for 2 years. They can be on their job for 1 day, assuming that they've been in the same line of work for at least 2 years.
Okay.
Yep.
What about whenever they're in school? Because I know we talked about that. Say
Yes.
they just graduated from college.
They just graduated from college and then they got a job. Well, great. You were in college for this job. That counts. Okay.
Yeah.
Assuming you were in school for 2 years, right?
Yeah.
Assuming you were in school for some period of time. So I don't know, let's just say I'm working at McDonald's, right? I'm working at McDonald's, but I'm going to school full time to be an engineer.
Okay.
I graduate and I got a job offer for $150,000 a year. Boom. You make $150,000 a year. We're going to count that because you went to school for that degree, and we're not going to harp on the fact that you weren't working as an engineer for the past 2 years. You have a degree, you got a job offer, and you were focused in school on that trade. Now, conversely, don't go to school to be an engineer, get out and become a landscaper, unless it was landscape engineering.
Right.
All right. So, don't
now you got a little problem.
Don't go to medical school and get out and become a data entry person.
Right.
We're going to need 2 years of data entry work now. There are some ways to kind of skirt that with experience, job titles. Then you start bringing in job titles, okay?
Right.
And it's always a sale. These files, home loan applications are underwritten by human beings. It goes through a computer first, but then ultimately a human will look at it. And it just has to make sense, okay? Where you're in customer service and now you're doing something else, but you're still in that same vein, you're still doing the same things like customer service was doing for a while. That's believable. You just can't have a huge switch in what it is that you're doing. You can't go from being a landscape manager to being a doctor. Sorry, that won't fly. Now, it doesn't mean we can't count your income. Doesn't mean you don't qualify. So let me go back and say that. Because you switch jobs doesn't mean you don't qualify. It means that we're going to have to calculate your income differently. And if you went from making 50,000 to 100,000, you're probably going to get credit for about 75,000. You're not going to get credit for the full 100,000 until you've been earning that for 2 years.
Right.
That's
Okay.
because of the job change or the career change. If you get a big raise, but it's in the same line of work, ooh, we can count that new raise. It's going to have to be verified and it's going to have to be documented, but we'll count the fact that you just went from 60 to 75 because you switched jobs, same title, same job description, more money. We can count that new money. We can't count new money if it's in a different framework of work.
Okay. Okay.
Okay, so day one, how long do you have to be on your job? It totally depends. You just have to have been employed for the past 2 years, and then your income is just going to be up to some scrutiny. And that's what we need to figure out what we can count for your income.
Okay. And then ideally, as far as credit, what do you say? And I know your credit, DTI, what would you say? Kind of talk about what your credit needs to look like. And then we can kind of tap on that DTI.
Okay, credit depends. Credit depends on down payment and loan to value, right? So let's say we're talking to the first-time home buyer. Okay, in that case, first-time home buyer without a lot of money, we need a 580 FICO score at a bare minimum.
Okay.
A bare minimum 580 FICO score will get you qualified for a loan, and you can borrow up to 96.5% of the home price. A 620 FICO score will get you qualified to borrow 97% of the money. You'll have to come up with a 3% down payment. Now, the beautiful thing about the 620 mark is that now you can probably qualify for some pretty good down payment assistance programs.
That helps you out. Yep.
That helps you out. So now, essentially, you're borrowing all of that money. And let me not take that 580 person out of the box, because you can get 100% financing with a 580 FICO score also. It's just not going to be a lot of options as with the 620 FICO score. So 580 at a bare minimum, 620 is better. If you get in the 680 range and higher, you just have options of more programs and better rates. So let's take borrower A and B equally compared across the board, everything, been on the job same long time, make the same amount of money. The only difference between the two people is FICO score. The person with the better FICO score gets a better interest rate. That's right. About the only thing. You don't get a cheaper home. You don't get a less closing cost. You just get a better rate.
Yeah. Now, as far as, go ahead with the DTI.
Debt to income ratio. That's a good one, because a lot of people have bad credit or credit challenged, right? Yep. A lot of people are credit challenged and they think, well, I've got student loans, I got car note, I co-sign for my kid, I'm making all kind of payments. Debt to income is based off of what we account to your credit profile. So let's start about with the co-sign first. If you co-sign and the other person is making all the payments and they can document that, bank transactions, cancel checks, that's not going to be counted against your debt to income ratio. So let's get that off there. If you have student loans,
that's a good one. That's a big one right there.
My first advice is do the research and get those student loans forgiven. I've got a lot of clients right now that have gotten those student loans forgiven. The Biden administration is forgiving a lot of student debt. Try to get it forgiven. That's number one. Number two is, if you're in deferment, we're still going to have to count something of that, okay? I tell people, don't be in deferment, get put into what they call pay as you earn, because that's going to be a payment structure based off of what you earn. And believe it or not, it's really small. It's like small. So then we have a documented payment that we can get reported on your credit report, and that will go towards your debt to income ratio. If your credit reports as zero, or your payment for the student loan reports as zero, that can be interpreted different ways depending on what loan program you go with. Some lenders are going to apply a minimum payment at 1%. Some lenders are going to apply a minimum payment at 0.5% of your balance. It's really easy math. If you owe $5,000, multiply that by 0.5%, and that's what we're going to count as the payment. That's $250. And some lenders won't count at all. The guideline simply says if it's reporting as zero, put the payment at zero. Okay. Right. Credit card. They say, oh, I got $10,000 credit card debt. What is the minimum payment on your credit card? $40. But I pay more than that. It's not the question. The question is, what's the minimum payment? It's $40. That's what we count for debt to income ratio. We count minimum payments. We count things that you actually make, not stuff you co-sign for. And the other one is if it's an installment loan. So some of these are personal loans, usually a car payment or installment loans. If you have 10 payments or less, we won't count that. Yeah, you got to make it. But when it comes to the debt to income ratio that we're trying to calculate to get you qualified, we're not going to count the car payment against you that you have more than 10 payments on. Some advice that I've given clients in the past is, how many payments do you have left? Oh, cool. Make this one lump sum payment to get it down to 10 or less. Now we don't have to calculate. Now we don't count that anymore. Where are you at on your debt to income ratio? Car payments taking a lot of your money. Go refinance that car. Get that payment down. Go refinance that car, get that payment down. That changes debt to income ratio. So that's where debt to income ratio plays in. Go ahead.
You know, we've had that situation before.
Yes, ma'am.
And people don't, I don't know if it's just they don't know that, you know, anytime when it comes to, say, even your credit cards, like you could go back and negotiate your credit card, you know, rate and everything. You can go back and renegotiate your car payment, refinancing it to get a lower payment or to get, you know, so it's one of them things I think people just don't know. That those options are out there. Like, I think, I know I talk to people and they'll say, you know, they bought their car 5 years ago and they've been paying their car payment the whole time, and they might be at a higher interest rate and they think that they have to keep that and they can't go back and refinance it. So yeah, so I'm glad you brought that up.
There are a lot of options. There are a lot of options. There's two things, and we won't get too analytical here, but there's front end debt to income and there's back end debt to income. So the front end is dealing with housing expenses only, principal, interest, tax, insurance. The back end is when we add in all of your other things, your minimum payments on your credit cards, any kind of revolving debt, installment loans. Generally speaking, currently, you can get away with a 50% debt to income ratio on most loans. And people will be like, oh, I thought it had to be 40. That's front end. That's housing expense only. But on the back end, we can get away with 50%. I got away with a 56.8% DTI on a client recently. It's all up to lender guidelines, and they're different with every loan program. And it also goes through this system called automated underwriting, where they look at other compensating factors. So your credit is okay. You got good money in the bank and no late payments. You can get away with a higher DTI. It's just how it works. So debt to income is the amount of money you bring in, and we look at how much of that money is going to go out towards your revolving installment, credit expenses, and your housing, which is principal, interest, property taxes, and the homeowner's insurance. And that number needs to be, for all intent and purposes, 55% or less of your total income, and you qualify.
Okay.
You want to keep it around 50 so that the box of programs that you can qualify for becomes larger. But don't think that because you're pushing a 50% DTI and the bank told you no, that you don't qualify. That's just not accurate.
Back to the student loan part. What would you say the two things? I know you said loan forgiveness, number one. And then, because you do see a lot of people that sign for their children to get student loans and everything. How does that, I mean, that might be going down a whole rabbit hole, but.
The same thing. So if the loan's in your name, but you're not the student, that's your debt to income ratio. Okay. Unless your child is of age and making all those payments, then we can show that, hey, these payments are being made by this student, and the underwriter will easily account that debt to income or that expense, not as yours. The other way is really just lender guidelines. Again, you're either going to have to report it as it reports at 0.5% or at 1%, depending on the type of loan program. Even how it's underwritten. Fannie Mae and Freddie Mac are different. One of them wants you to calculate 1%. The other one wants you to calculate 0.5%. FHA is at 0.5%. Some lenders have their own overlays and they will excuse it altogether. I would go the forgiveness route. And if you can't get it forgiven, you want to go pay as you earn.
Okay.
That calculates it based off of what you're earning. And I had a guy who was in deferment, right? And we had to get him out of deferment to qualify for his loan. And out of deferment, they told us what his payment would be. But pay as you earn was less. Oh,
Let's do the pay as you
and
earn.
then he qualified. And we were waiting too. Like his escrow was running in the days, and we needed the facts, not the phone conversation, not what they say, but we needed the actual documentation. And it took a while to process, but by the time it got done, we were ready to, rock and roll because everything else had already been done. But yeah, there is always a way.
Yeah. Yeah.
And if it's not immediate, at least you have a roadmap of what it's gonna take and how long that will be.
And that's exactly what I want this conversation to be about, because of the fact that people aren't, what hurts us is what we don't know. Once we get the information, then it's up to us to take the lead and say, okay, these are the things that I need to do to get qualified.
Yes. So a question popped up in there asking what is the highest DTI? I did hit on that, but just to make sure everyone can hear. It's going to be different on the loan program. It's going to be different for the lender. 50%, you're pretty squared away everywhere, okay? But you can go as high as 56.9% on some loan programs. And on VAs, I hate to say this because I don't want everybody to be like, oh my goodness, really? There is no max DTI for a VA loan. A veteran can be at like 60-something% and they're gonna qualify. Veterans deserve their just due, man. So there's no max DTI on veterans. Most of your conventional loans, your back end DTI is gonna be 50%. You can get away with some FHA products up to 56.8, 56.9%.
Okay. So we talked about credit. We talked about DTI. What else? We talked about job
We can talk about
history.
money. We can talk about some money.
Let's talk about the some ching.
Yeah. So even with 100% financing, chances are you're going to have to bring some money to the table because 100% financing means we're going to finance 100% of the purchase price. You got to help out with the closing costs.
Yes.
Now you can go the route of getting assistance on that too. So there's a lot of loan programs you can get up to 105% of the purchase price. That 5% covers your 3% down payment or 3.5%, and then that extra 1.5% or 2% should cover your closing costs. And if there's anything left there, I'm pretty sure we can get the seller to go in. And if not, what were you going to do with your rent? You're going to pay it? Bring that rent money to the closing table.
Right.
If you have to go rent a new place today, you got to come up with first, last, security deposit, application fee, bring that money to the closing table. I hate to sound like this, but stop looking for 100% financing with nothing out of your pocket. Like you didn't get into your apartment with nothing out of your pocket, but we can give you 100% closing costs. 100% of the purchase price. You've got to have some skin in the game.
Yes.
Generally between 1 to 3% of the purchase price to make sure you have all your closing costs covered. Where that money comes from, it can be gifts, it can be gift of equity. So gift of equity means it ain't even cash money, it is someone's equity in their home and they're gonna swing it over to you, okay? This happens a lot. You can buy a property from a family member and they can gift you equity. And give you the 10, 20% of the down payment right there. And you only borrow the rest of that. Mom, dad can take money out of their 401k, IRA account, savings, jobs. A lot of jobs have programs that if you want to buy a house, they will give you money towards your closing costs. Some of it is a gift. Some of it is money you're going to have to pay back. But that is all money acceptable for you bringing to the closing table. Every city, every county has own smaller programs, usually through nonprofits, where if you take a course, you do this counseling, they'll give you $1,000, $1,500. Go to 3 or 4 of those things and collect 7, 8 grand. Now, they're not going to give you the money. They're going to apply it towards escrow, which means you need to have a sales contract. You need to have a good faith estimate or a loan estimate. You need to be in the process. And that's where all this money can come from. But you should have, the staples has always been 1% to 2%. I tell people up to 3% because of where rates are now, right? We need to think about buying rates down. We need to think about being as aggressive as possible. So 1% to 3% of the purchase price is where you're going to be on closing costs. You need to have that money accounted for. And let's talk about money for a minute. It can't be newfound money. So what I mean by that is you can't tell us you'll have it. You got to show it. And the general route is you need 2 months bank statements, right? They're looking at a lot of things on those bank statements, verifying the income that you say you're earning, verifying money you say you haven't closed. But if a month one's bank statement has a balance of $3,000 and month two's bank statement has a balance of $15,000, they're going to ask where the 12 grand came from.
Right.
Okay. You can't have newfound money. Now, wait a minute. You said you can get a gift. You can. We want to know where that gift came from.
Yep.
And
let's talk about that whenever, and I know we go down this rabbit hole, but okay, so if mom says she's going to give you $10,000, right? Mom writes that check for $10,000. Kind of talk about what you need from mom when the lenders say, hey, we want to know where this, it's not just them saying, oh, it came from my mom, and my mom sends a letter, a handwritten letter saying, hey, I give my child $10,000. So kind of talk about that. What does that look like?
We're going to take that handwritten letter and then give you the appropriate documentation. So there is a gift letter that's pretty standard across the industry. Just has some different terminology, says that this is a gift, expected to be no repayment, who's it from, who's it going to. Then we put the loan number, the property address, some other stuff on that letter. And then mom or the gift giver will have to sign that letter. But essentially, it's going to ask a couple other questions like, has the money already been given? Or is it going to be applied during the escrow phase? And I always say, well, if the money hasn't changed hands yet, let's not change hands. Let's give it straight to escrow. Mom can wire that money directly in escrow or do a cashier's check, whatever escrow says. Because what's going to happen is same rules apply. We need to see mom's bank statement.
Right. And it can't be marked out.
No, we need to see mom's entire bank statement.
Yeah.
All pages without redaction. I don't want anybody in my business. You don't want your kid in a home.
Yeah.
They're not going to report you to the IRS. They're not going to ask you for any other questions. They're not going to audit you. But we have to see that the money, let's just be real. We have to see that the money didn't come from a terrorist organization.
Right.
We have to be sure that the money didn't come from drug proceeds. We have to be sure that the money is from legal means. And the way to do that is to verify that the funds have been sitting somewhere for 60 days.
Right.
And this is a lot of stuff that came into play after 9/11, money laundering laws. So the easy route here is if you're in the market and you don't have the money now, it's going to be 60 days before we can close. Let's talk about it. Put the money somewhere and let it be in that account so that when your lender says, give me 2 months bank statements, it's in month one and it's in month two. Now you don't get the questions, where did it come from?
Right.
Unless in month one, you can see the large deposit. So this might be a 3-month process. You might have to put the money in there and then wait until you have 2 months without any large deposits. And now there's just no questions asked. Where'd that money come from? I saved it.
Yeah. Here we go.
Here's my bank statement. It's been in my bank account. So the same will be true if it's yours in the bank account, or the same will be true for the giver. We have to see 60 days of bank statements showing that that money was there. Now, if the money got moved from a savings account or from like a retirement account into the checking, cool. Show me that.
Yep.
Show me that transaction statement of the money being moved. It's pretty simple, but there has to be a paper trail behind the money. So your credit's got to be, doesn't have to be perfect. It's got to be 580 to 620 at a bare minimum. Got to be aware of outgoing monthly expenses and reducing those debts as much as possible. If you got a lot of small credit cards, get them all to 0 prior to filling out your mortgage application so that when we pull your credit, there's 0, 0, 0, 0, 0. Because all those little minimum $25 payments, they add up and they affect your debt to income ratio.
Yeah.
And we talked about the money. You got to have somewhere between 1% and 3% for your closing costs. Now, again, we can do 100% financing. We can do 103, 105% financing, but you should have something just in case. The seller can contribute, your job can contribute, all of that. So it is possible to get into a house with absolutely no money out of your pocket. But if you start the process that way, it's just not, it's not being very realistic. You need to start the process.
You need a little skin in the game.
Renter.
Yeah. The last thing I was going to ask you was, as far as time frame, because another thing is that I see is people think that, purchasing a home is like purchasing a car or going to get an apartment. So realistically, start to finish, they have money saved up, their credit is together, they fill out the application with you. What is that time frame like to get them, of course, with the inspection and appraisal and all of that?
Underwriting.
Right. What is that time frame ideally look like?
So based on the framework, the way you presented it, 30 days or less.
Yeah.
Okay. That's just normal. And I'm not a realtor, but I think if someone's selling their home, they need a little bit of time to pack, find their replacement home. There's a lot of moving parts. So generally, you're looking at 30 days or less on a normal escrow. Okay. That's the whole process. And that's assuming that when you get asked for something, you turn it over.
I was about to ask you.
So we say, okay, 30 days or less, I need 2 months bank statements, I need 2 months pay stubs. And 3 weeks later, you turn in your pay stubs. Okay, 30 days from now, because there's a process. And banks don't like, lenders, investors don't like trailing documents. Trailing documents is, here's the loan application and credit report. A week later, oh, here's the title paperwork. A week later, here's the pay stubs. A week later, oh yeah, let me order the appraisal. No, that's not how it works. If we do go through the full pre-qualification, pre-approval process up front, and all that documentation is provided, and the only thing we're waiting for now is a home and that purchase contract. Mind you, the appraisal and the inspection will happen after that, but we can knock those out in 2 weeks or less. We can close in 12 to 15 days if you did your part up front.
Right, and very organized and have everything together before
everything's
you ask
together.
Yeah,
everything's together. Next time you got a pay stub, you're automatically sending it in to your lender instead of waiting for them to ask. And you're on top of your game. And you look at a house and you find it and you write a contract and that offer is accepted and you have a true pre-approval. We can close in 2 or 3 weeks. Easy.
Yeah. I love it.
But go in thinking 30 days.
Yep.
And you'll be all right.
Sounds perfect. So I know we kind of went a little side left, me. He's like, that's
all the tea. But you know what? The more information they have, the smoother the process is going to be. And there's just so many misconceptions out there. But if you can qualify for an apartment through a management company, let's talk about that, right? So not renting from the friend or whatever, but if you can go to a management company and fill out their application and qualify for their apartment, you most likely can qualify for a home.
Right. Because look, with the apartment now, you have to make 3 times the monthly rent. You have to have job stability and everything like that. So it's like, you're purchasing a house, but just not the you might have to come to the table with a little bit more money, but long term you have your home.
And let me say something about that qualification thing you mentioned. You got to make like 3 times the rent for an apartment. Generally speaking, and I say generally, a home borrower, someone looking to buy a home, will qualify for 5 to 6% of their annual income. So borrowers, if you're a husband, wife, co-borrowers, whatever, put your money together
Yes.
and multiply that by 5 or multiply it by 6, and that's depending on rates and temporary buy downs and all that. Multiply that out by 5.5%. And that's how much money you can qualify for on a home. So you make $100,000 a year combined, you can buy a $500,000 house. On paper, now we just got to take care of the things and make sure you can afford it and it all makes sense for you.
Yes.
So you can only qualify for 1/3 of your rent, of your income for an apartment, but you can qualify for up to 5 times your income on a home. Which one makes more sense?
Right. What makes more sense?
Yeah.
I thank you. Look, it's 1 o'clock.
All righty. I got work to do.
We got work to do. If anyone needs to get in contact with Antonio, reach out to him.